Welcome to Adding Value with Assar, the show where we dive into the stories, strategies, and market insights shaping the world of industrial and logistics real estate. In each episode, we sit down with industry leaders, investors, developers, and tenants to explore their journeys, unpack current market trends, and share takeaways that can help you better understand and navigate the business. You guys can work through this, right? Like you can
screw up all you want. You can screw up all you want. You're doing real well on this to start. So I see things being positive going in.
Well, it means good news for all of us.
I hope so.
Yeah.
If not, you can roll back the tape and yell.
Yeah, that's right.
I would say a common trait and something for young people or new people in the industry to think about for successful brokers is the ability to listen.
Value creation is not just about the numbers and the financial stuff. It's about creating value for our customer.
I remind myself, like, this is the business we got into. This is what we got into.
Yeah.
The prerequisite was that you just don't give up.
We having the Kelsey brothers on next time?
Maybe, who knows? Today's guest brings a rare blend of structured finance expertise, development experience, and big picture capital strategy. Michael Anderson-Mitterling is a managing director with more than 15 years in the real estate industry, specializing in complex capital stacks and structured finance. He has arranged over $5 billion in debt, equity, and structured financing, everything from senior and sub-debt to joint venture equity for major projects across the country. Today, we're diving into today's capital markets landscape, what financing really looks like right now, what lenders are prioritizing, the best path forward for owners, investors, and developers, and how borrowers can secure the strongest terms in a competitive environment. Welcome to the show. So I'll tell a little backstory. Okay, so Mike, thank you so much for joining today. I remember when we had first met, I had just gotten into the business. We met through a mutual friend. I was interning at BKM Capital Partners, and we were just kind of talking about how much they have grown since 12 years ago since we met. And my understanding is that, you do a lot on the capital market side. You were providing debt and equity solutions for them. And at some point, my father, who's an owner-user, was looking to potentially buy a new property and move his business into. And we connected, got introduced through Brett Turner. And why don't you tell us a little bit about yourself, a little bit about GSP and the types of solutions you guys provide today in the market.
Absolutely. No, Shai, thanks for having me on here. This is awesome right after the holiday, and still recovering from the turkey tryptophan, but it's so I got in the business in like 2009, kind of dating myself at this point after somewhat being competitive sailing and on the U.S. national team, and Olympic team for sailing, and had to find a competitive outlet. And my mentors were like, go into real estate. And so I did, and kind of through the years have always somewhat had an industrial specialty, and kind of like fast forward, I joined GSP, and man, it's 2011. And that's taken some trips around the cycles here. And GSP, really what we are is we are a middle markets capital markets firm solely focused on capital. So what that means is we're debt, equity, sub-debt, and structured finance. And so that is all we do. And we focus on most asset classes. So, industrial, retail, multifamily, hospitality. We also do very niche products. We do marinas, we do land, we do horizontal and infrastructure. So, but really, and our clients range from, as you just mentioned, like your dad, and an owner-user type product, and mid-market investors to major funds, such as BCAM and major REITs and major institutions. So we really do run the gamut. GSP now is a full national firm as well. We have offices New York, LA, Atlanta, Dallas, Detroit, and Seattle, with the focus on opening one in South Florida and one in Chicago. So we've grown since that time in 2009, and it's been fun to be a part of.
When you say middle markets, is that like a certain size range of loans you guys try to focus on?
Yes, and so I think the nice thing with GSP, it's we can do small loans, right? Like your owner user and be really hands-on with clients, and in that $1 to $10 million range. We also go as big as 200, 300, 400 million. And just last year, one of our partners in New York, did a $600 million land facility. So again, for a major home builder. So I mean, to give you a spectrum, so we kind of run that full gamut. But but what GSP, the differentiator is that we're just capital, and we are client focused. So we price and structure capital for that client's needs, and whatever that looks like is what our job is to identify and structure around.
And what type of clients what would you say more naturally gravitate towards your firm? Are you finding yourself working more with users, investors, institutional? I understand you guys can service all the business,
Yeah.
but what type what's the exact value proposition? Who's it reaching to out there?
I'll speak for myself, like personally. And I would say my clients, honestly, it ranges, right? I do have clients who are owner users, and we kind of follow their book of business as they grow. And again, right, like it's some industrial and manufacturing users that buy a building, they have to grow, and they use owner user financing, or or some of our major funds, we are just structuring either their equity and equity partners, or their acquisition facilities, or just honestly debt for them, whether that's bank debt, credit, life co, and so it kind of follows their geographic regions as well.
Got it. And so I'd like to learn a little bit, because my understanding is, I remember this, we were kind of experiencing it with you guys. You guys run a full process, right?
Yes.
Client comes in, they kind of explain to you what it is they're looking to accomplish, whether that be an acquisition for their business or whether it be an investment that they're trying to secure debt for. And in many ways, you put together like an offering memorandum, like brokers do, and then you take some time and then you go shop the market. Is that fair? Is that kind of how it works?
Yeah, no, it's I kind of always think about it as like we have two sets of clients at all points in time, right? We have our client who has engaged us to help them solve a capital need, right? Whether that's an acquisition, whether that's a refinance or whatnot. Other clients are the capital, right? Whether that's our life insurance and correspondent relationships, our bank partners, our private credit, and these are like your debt funds, your funds of funds, your hedge funds, non-bank execution, and again, right, your banks, and then also your kind of your government agencies through that. And so whatever the client's need will be, so let's say it's an owner user, right? We will work with them in identifying, hey, what is it that your need is? We'll underwrite what their requirement is, right? So if it's a manufacturing facility, it's like, hey, do you qualify for an SBA, or are you too big and you have to go to owner user financing? So we do a full underwriting of what their company is. We do an underwriting of what the real estate and the collateral is. And then we prepare a package and a request that fits what the market can price for that client. And so we work hand in hand with the client to identify, where the strengths are, where the pitfalls are, so that we can identify those and put collars around it and identify that. And then our job is to go out to the capital markets and identify the best partner for them.
For that specific need.
Correct. And best partner can be looked at a whole bunch of different ways, right? It can be looked at as structure. It can be looked at pricing. It can be looked at a mixture of both. It can just also be, who do I like the most, right? It's not always, I think one of the biggest misconceptions in our industry is that it's like, oh, we're always pricing focused. And sometimes that's not the case, right? Sometimes you want to identify the best partner on the capital side, because that best partner is going to help you solve issues when issues arise. And yeah, they might be 10, 15, 20 basis points wider than the tightest pricing, but you know that through that process, when there is an issue down the line, which there always will be, they will be there to help you solve it. Versus, maybe that tightest one is just, you're handed off to a servicer and they're going to restrict everything that you need to do, and they're not going to be your partner, right? So
there's a relationship component there.
That's correct.
Got it.
That's correct. And so our job in that capacity is to run that process to identify who that best partner on the capital side is, and quantify and qualify what that looks like.
A quick note for our listeners. If you're an owner, asset manager, or leasing manager with a 100,000 plus square foot building in vacancy coming up in the next 18 months, I'd love to talk. A lot of assets in this market have been represented by the same legacy brokers for years. Sometimes that works, and sometimes it doesn't. If you're ready for a fresh, aggressive approach to reposition and market your property, please contact us. I'm Assar with Voight Real Estate Services, and let's add value to your portfolio. You know what's interesting is, so I obviously work in industrial in the Inland Empire, and as the market has pivoted, my business has, fluctuated from sales to more leasing now, just because the sales velocity has been down. Having said that, I think in 25, I've done 3 different user deals, and every one of the user deals that I've done or represent a client to acquire have all been cash deals. And I think a piece of that is because there's this perception that, financing is expensive. But at the same time, when you look at the values where they're at today, they've dropped enough even on the user sales where if you are a cash buyer out there, it makes sense to acquire them.
Absolutely.
So I share this to say, what is going on the owner-user financing? Because we were having a conversation and you were telling me that it's actually priced pretty aggressively today relative to historic standards.
Yeah, I mean, look, I think the answer is yes. I think owner-user financing, and I think just the capital markets in general, is priced actually very, very tight. I think the misconception is we had an anomaly in the marketplace, right? In 21 and 20, before the rate hikes, right? Like we were in a 0 rate environment.
Correct.
Because of COVID and the after effects of that. And that's not normal, right? Like that was a blip in time that created a perception of what debt capital is. But if you look at, you look at pre-GFC, post-GFC, you look at, the kind of that first round of rate hikes right before COVID, like 18, 19, like we're actually inside of that today. And so if you look at the kind of the curve, we're actually at a time point where debt capital is actually some of the most aggressive capital you can get in today's environments. It's just that we have a perception of the last 24 months, like pre-rate hikes, we just have this perception of like, hey, rates were free. But, when you can go get debt for, plus or minus 6% in a lot of cases, long term, that's not a bad, cost of capital. And especially if you think about it, right? If you're an owner user or even an investor, right? If I can go get debt, even at 6.5%, right? I can go use that capital for my business and grow my business at a higher rate of return than that 6.5%.
For sure.
So, when you start thinking through that big picture, you're like, oh, capital is actually really not that expensive. It's just a perception because of what we kind of went through, right? That really accelerated the market in a different way. So, no, I think because there were so few transactions as well in 22, 23, 24, there is a lot of liquidity and competition on the debt side. So there's a lot of lenders that are fighting for business today. Okay. And as a result, we've seen credit spreads come in. We've seen lenders be competitive. And, to kind of go back to your original, question, like what's our process? It's kind of our process is to find those outliers, right? Like which lender which relationship is going to stretch for that business and that partnership? Because what we have found, because of that competition, and depending on what time of year or what, where we are in their capital allocations, they're stretching.
Mm-hmm.
So it's a good time to be a borrower in this landscape right now.
And if I'm an owner user, and owner users typically buy buildings or assets once every 10 years, say, for example.
Yep.
So when you go through that process in underwriting their deal, for the most part, it's new. It's a new landscape for them. What are some of the key metrics that lenders and capital are looking at, or you think are important that they have to be aware of in underwriting the deal and getting them approved?
That's a really good question. So, I mean, in every deal, there's always three legs. Three legs to the stool is what my old mentor always used to tell me, right? You have your sponsorship, which is, hey, what's the business? Who's the owner? What's their financial wherewithal? What's their strength? The market. Does the business, does the strategy fit within the market? Like, what are the market dynamics? Like, for instance, like if you're trying to do an apartment building in a major industrial center, like that doesn't fit, right? And then kind of your third is, what is the business plan, right? Like does the business plan meet and fit what the sponsor can accomplish, and does the collateral make sense? So, assuming all three legs. So in the underwriting process, what we're looking at is first and foremost is sponsorship and business and ownership. So that is, it's a grind, right? You have to look at financial statements like, hey, what's our revenue? What's our EBITDA on just the company side? Hey, what's our balance sheet look like? What liquidity are we sitting on? What's our recurring debt? On that, are there any blemishes? Right? If there are blemishes, that's not a no-go. Let's just know what they are. Like, is there a story behind it? Let's make sure we understand what that is so that we can build a full picture on what that looks like.
Do you guys forecast the business's growth as well?
We ask for that, yes. And so it's important for us to understand, say, where has the business been, where is it today, and where is it going? Because again, on the owner-user side, from the lender standpoint, owner-user financing is a little bit unique, right? It's not investor financing, because in investor financing, they're just going to look at the collateral.
Correct.
What's the cash flow, size it against that, and move on from that. In an owner-user, you kind of have that extra level of scrutiny, right? Because your borrower and your tenant is the owner and the principal of the business, right? So if that business fails, then the collateral is empty, right? So for the lender in that standpoint, they want to make sure that the business, one, has weathered storms, there's a clear line of growth or sustainability, right? And that there's a very steady benchmark that they're hitting. Then the next piece, then they'll underwrite the real estate, right? Like, does the price point of the real estate meet the market? Are you overpaying? Are you underpaying? What is it? Is there CapEx that's needed for the business to go into that? Let's make sure that there's enough in the loan proceeds to either do the CapEx, or that the company and the balance sheet of the company can actually do the rehab and the work in order to do that. So we'll go through that underwriting to make sure. But then they're also looking at, okay, what are lease rates in the marketplace, right? Because if that business does fail,
you have to lease it out.
You have to lease it out. So is at this basis and with these improvements that are going in, what is the ability for that to be re-tenanted? Can it be re-tenanted as is? Or is it a situation where all the improvements have to be removed, and then they have to take that into that calculation as well?
And that would be kind of your base case scenario.
Correct.
Conservative case.
Correct.
It feels like a hard box to check, though, I'm assuming.
Because
user valuation, at least in our market, typically is higher than investor valuation.
It is. And then that's also where that first piece of underwriting becomes so critically important, right? And really understanding the company, right? Because the company itself is what's substantiating the real estate, right? And so the real estate becomes an owner-user financing. It's a subsect of the underwriting. Like, it's not the underwriting, but it's a subsect of it. Got it. Right? Versus if you're doing investor underwriting and you're doing it for, a REIT or a private investor or, a fund of funds, is they're just going to underwrite the real estate, right? They're going to take, what's our cap rate? What's the business plan? What's our as is? What's our as stabilized? What's the cost to get to the as stabilized? And they're going to really focus on the real estate very heavily, right? because that's just a more of a, I would say, a commodity type collateral. But an owner user, it's so specific. So they're going to rely very heavily on the underwriting of the company, on the principles of that company, and what's the sustainability and runway of that company.
So moving to kind of financing for investors,
Yep.
What are some trends that you're seeing in the market today?
I think, it's interesting, right? It's on, like, our business is on the capital market side, is we're kind of split into two sides, right? Like, we have clients who are in active acquisition mode, right? And that's one mindset of underwriting and execution and collateral and capital that chases that, right? The other side is refinances and recaps. And in today's environment, I'll start off kind of refinances and recaps because acquisitions have kind of been down, right? It's just been very slow. So,
and just curious, is there a specific profile of acquisitions you're seeing out there, maybe more than others, even though the velocity's been down, or you're just like mostly stabilized deals, I'm assuming?
Actually the inverse.
Okay.
It's groups are looking for distress, right? Like it's, which has actually been very hard to find. And I think there was a perception in the market on the acquisition side that there was going to be more distress.
Absolutely.
Right.
That's what we all thought.
And it hasn't come, right? And really, it's because of that aforementioned one, right? Because we've been working on so many recaps, because lenders and capital, they've all kind of been in it together, right? Like the last, since the rate hike started in 22 and 23, you have a lot of loan maturities in 24. We had a lot of loan maturities in 25, and lenders themselves, they don't want to take that distress on, right? And so they've actually done the opposite. They've actually worked with borrowers. They've done extensions. They've done loan mods. We've actually worked with other capitals to restructure loans and or refinance, right? So it never hits distress or acquisitions.
So if I'm hearing you correctly, the distress that everybody was expecting to happen, essentially there were some Band-Aid solutions by the lenders.
Correct.
To make sure that didn't happen.
Correct. Because you have to remember, like, most lenders, they're in the business of lending capital.
Yep.
They're not in the business of owning real estate.
Correct.
Right? Like they're not operators. They're not and especially if you look at it on a fund-to-fund side or like the private credit side, they're also in the business of raising funds for their funds, right? So if they're taking a lot of assets back, that hurts their fundraising capabilities, going forward. So a lot of times they will work with their borrowers, and meaning like the borrowers have done a good job. They've said what they were going to do. Like, again, right? I'm taking out the bad actors, and
the negligent groups.
Correct.
Right.
And they'll work with them, and they have. And that's why I think you have seen a lack of distress, like real distress, like, let me rephrase that, the volume of distress that has hit the market. There has been distress that has hit, and those get absorbed and whatnot. But that's kind of been on a one-off case. So I would say that's been kind of and honestly bridge to bridge, which has been a very unique piece in this cycle, where it's kind of balance sheet to balance sheet, because normally you go from like bridge to like perm financing or bridge to sale, but because also groups don't want to go to perm financing yet because they still feel that there's more time to improve the assets and whatnot, a lot of private credit groups who are sitting on a lot of capital will go and just do bridge to bridge, which has kind of been unique in this subsect.
What would you say? I mean, can you say that there's kind of a rule of thumb on where the interest rates are at for bridge loans?
So yeah, and I would say, and it's really leverage based and risk based, right? If you're kind of middle of the fairway and you're at that 65-70% and non-bank financing, because I think what in this last cycle is you've seen a very large increase in that private credit, is you can be as priced as low as the mid twos over SOFR.
Okay.
Which, I mean, that's bank pricing, right? And that's a unique, and that goes into the prior conversation where it's like there's a lot of competition out there. So with SOFR today hovering around 4%, and knock on wood here, we've got the FOMC meeting coming up. Maybe we get another rate cut, and we see that coming down more. It's like you can structure high 5s, low 6 bridge debt.
That's pretty cheap.
Which again, we go back to the prior conversation, like that's really affordable debt.
Mm-hmm.
On the perm side, the irony is you're kind of in the same ballpark. It's you're not getting too much of a cut in pricing for long-term debt right now.
Mm-hmm.
So it's we're in an interesting time in that aspect, and that's why I think you're seeing a lot of that capital get absorbed in recaps and acquisitions, because you can manufacture that type of pricing in that private credit market. Again, not saying like if you're in 55-60% range, bank debt and life co debt, we can be in the low 2s, even the high 1s.
Mm-hmm.
So now you're actually talking low 5s type money for bridge debt, or kind of like mini perm or transitional type debt. So, again, the conception that debt's expensive, I think, is actually a misconception.
Mm-hmm.
I think debt's actually very aggressive today. It's just that our perception is that it's
more expensive than it used to be.
It used to be,
right? And you mentioned a good point. There are multiple different lending vehicles out there. Correct. And even myself, or even a lot of private owners, sometimes just the assumption is that, where you get a loan from is just the bank.
Yeah.
But that's not the case. There are a variety of different lending sources out there. Can you just kind of walk us through, say, the 3 or 4 most prevalent types, and maybe what the advantages and disadvantages would be going with one group versus the other?
Absolutely. No, it's I would say this is actually, look, it's been a grind in our business, but it's also been one of the most dynamic times in our business because of the competition. I would say the biggest winners right now are your private credit. And like private credit's kind of a really big umbrella. So that means like your debt funds. And so debt funds, there's multiple classifications of debt funds. There's debt funds that do CLOs, which is, they basically sell paper to Wall Street on the back end. They hold their first loss piece.
Mm-hmm.
And that's one structure. There are debt funds that have their own balance sheets. So they're actually use warehouse lines from the banks to hold their loans. And then those groups normally will service in-house, which is a benefit against CLOs. CLOs are normally priced a little bit tighter than warehouse, but even those are pretty balanced. But then you have kind of, I would say, your bigger fund of funds and your private credit that they are just their balance sheets, right? And they can, and like kind of the REIT structure, in which they can basically just lend their own capital at the rate that they want. So their credit boxes they're not restricted by the FDIC. They're not restricted by they can do what they want within their mandate of their funds. So a lot more flexibility. They can structure heavy value add business plans. They can put in interest reserves. They can take on risk, and they can price that risk within the spectrum. So we've seen that capital be very liquid and very prevalent in today's market, right?
Sure.
And really fill that void where banks have stepped away, because the banks got hit pretty hard after COVID, after the rate hikes, and they kind of like took a back seat in that, because of the restrictions that were put onto them. I would say the other really big bucket that has been very active is the life co bucket. They've really filled a big void that was left by the banks when they were kind of put on hold. And a lot of the major life insurance companies, and also the middle market life insurance companies, the perception is they've always been, hey, 10, 15, 25-year money, put it on the shelf and let it be. But the reality is, like, they've started to come down the curve. They've started to do 3-year money. They've started to do 5-year money. They've started to do IO. They've started to take value add risk.
Is that just because, to your point, that it's become more competitive and they felt like they needed to adapt to the market?
And they can get more yield on their shorter term capital, right? Like and this goes into the conversation that debt's actually pretty inexpensive, right? Like their long-term capital is not getting the same yields.
Right.
And so for them, as their actuaries look at, hey, here's our capital placement, here's our risk profile for the next 5, 10, 15, 20 years, is that they see an opportunity to actually get short-term capital out and get higher yield for their capital, right? And so they've really come into the market in a big way, and especially an industrial type product, multifamily product, and it's been actually pretty fun to be a part of, because you can layer in different competition with the funds, with the life insurance companies, and that's why I said it's a really good time to actually be a borrower in today's environment, because you have all these options. And then I would say, like, as of late, and really within the last, like, I would say year, banks have gotten back into business in a big way, and they aren't taking the same risk they used to. But what they are doing is their balance sheets are stronger. They do have liquidity to lend, and they are doing that. And so, we're seeing them go up to 65% in cases. They are in that low 200s over. So just inside of that private credit group. But what they aren't doing is they aren't taking that same risk. Right. Like, they're going to be more of your core plus type execution, light value add, still very, very sponsorship focused. And so, that's a kind of a tighter box to hit most of the time. But, again, right, I think it's, as a borrower, as an investor, as an owner user, you kind of have the ability to, and what's fun for our side of the business right now is that we get to go to this market,
flexibility,
and we get to create a menu per se, right? Like, there's actual real competition for borrowers in today's environment. And I would say some ancillary type products that have gotten really aggressive again is CMBS. They were priced wide for a really long time, but their AAAs and the bonds have come in, so pricing's back into a range that really makes sense. CMBS is great for leverage, great for IO. You do have to deal with the noise around compliance and just CMBS in general, but if you want to put something on the shelf for 5 to 10 years, IO, highest leverage, like, nothing's going to beat that. And then, you still have, like, your small, like, credit unions and other type products. But I would say less so.
Got it. You guys recently closed on a big deal, funded a big deal with BKM.
Yeah.
Can you tell us a little bit about that deal, how it came together, and the type of financing you're able to, if you can disclose, the type of financing you're able to secure?
No, and this is a prime example, right? Like BKM's been a great client. We're very fortunate of those relationships. I mean, I would disclose what I can, but what I think this is a prime example of, like, where we are in the capital markets environment. This is a deal that was a value add deal. It was being acquired from a group that was at the tail end of their fund. So there was no more capital going into it. So it was a heavier lift, right? Which fits right in the wheelhouse of the client. We ran a very competitive process, and that ranges from banks, life insurance company, private credit. Through that process, a life insurance company came through, a bank came through, and two private credit groups. Ultimately, through the structuring, and this goes into the piece, right? Like, who's the best relationship, who's going to provide the most flexibility, obviously pricing, fees, and execution, and private credit won. Right? They won it substantially. They provided meaningfully more proceeds. They were priced well inside on, basically manufactured sub 6% debt. And they provided 100% of all the CapEx and future funding.
Wow.
So, all the TILC money, there was some deferred maintenance that needed to be HVAC systems. It was a portfolio, so they also structured release provisions. So, excuse me. So, I find it I find it very valuable in, like, today's environment, where it's like, that was a very complex business strategy. And through the process of going to market, not only were there multiple options and multiple competitive options, but it allowed the best option across all pieces of the business plan to emerge.
Mm-hmm.
And so, ultimately, and in the closing process, and in today's environment, you always have to always work through appraisals, and we were able to do that. And I think that's also a unique thing with private credit and the credit side, is that there's more ability to kind of work with your partner.
A little bit more nimble.
Correct. And so that was also another big reason why. So, I think that's, and, there's always your bumps in the roads for closings. But, there were solutions all the way through. So that was also why.
So for not only owners or borrowers, but also brokers, because as industrial real estate brokers, we obviously get a little bit of exposure to the lending side of the world, but for the most part, it's not our cup of tea.
Yep.
What are some good ways for us to, just kind of be educated in the process, stay informed, and how to secure the best terms we possibly can for our clients?
Yeah, no, I think that's a good question. I think look, in our business, there's a whole bunch of great capital markets guys. And I have a lot of friends at different shops. I think the best thing to always do is never be hesitant to pick up the phone.
Mm-hmm.
I think anyone sitting in my seats and, my friends at other shops and competitors, is we are more than happy to share what's going on in the marketplace, right? Because the more knowledge that gets passed through, that just gets cycled all the way through, right? And as that gets into the system, hopefully that means more transactions down the line. It helps brokers, sales and buyers really formulate strategies on, hey, what's the price point to make a deal work?
Mm-hmm.
Right? Because I think right now too, is like, if I listen to a lot of our clients on the acquisition side, is there's still a very big disconnect between buyers and sellers, right, at price points.
Mm-hmm.
But they always blame the debt on those price points. But if, investment sales brokers and or buyers are talking to capital markets guys, they'll learn that the debt's really not that far off. So why don't we actually all work together and be like, hey, how can debt solve this acquisition issue?
Mm-hmm.
So no, I always say, like, pick up the phone and have the conversation, and with whatever capital markets individual that you like the most.
Sure.
And luckily we live in the day and age where information is effectively free.
Yeah.
So and plentiful. So it's just just always keeping up to date with that stuff.
Absolutely. And do you guys have like market reports, I'm assuming you guys put out, or information that somebody wanted to follow you and kind of stay up to date with the capital markets? What would be the best way to do so?
No, absolutely. So yes, so every week GSP puts out a FinFax. That FinFax, highlights 1 to 2 most recent deals. It'll highlight recent market trends, what today's rates are, and we have an absolute genius on our team, David Pascal. Pascal's perspective, 30-year veteran who really puts a spin on what's going on in the macro market. And for me, I'm a simpleton. He dumbs it down in the simplest of ways, and to make very complex things understandable. And so I think that's one, follow the FinFax on GSP, and again, right, like, I, not to belabor the point, but like, CB puts out great markets. My buddies at Newmark, they've got a great marketing department, and all of this, and I would say they all kind of somewhat pull from the same data sources.
Sure.
And so you can kind of get a really clear idea on, be like, okay, here's where the market is. Like, here's where the spectrum is. Here's where the Newmark reports are. Here's where the Colliers reports are. Here's where the GSP reports are. And then through just correlation of all those, you'll see the kind of the similarities and be like, okay, this is where the market is.
Right.
So yeah, I would say for myself, always look at GSP first.
Sure.
But I would always correlate it against all the other guys too.
And what would be the best way to reach you, Mike?
The best way to reach me is email. It's at manderson@gspartners.com, or my cell, 949-287-1060.
You got it. All right, man. Well, thank you so much for coming today. Very informative, and I appreciate you coming on.
I greatly appreciate it.
You got it. Thank you, Mike. Thank you for listening to Adding Value with Shai Assar. We'll continue bringing on guests with stories and insights that matter in the world of industrial real estate. If you enjoyed today's episode, please share it with a friend or colleague. And if you're a landlord, tenant, or investor exploring opportunities in the Inland Empire, feel free to reach out to us. We'd be happy to help you navigate the market.